Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion.
All right, let's dive right in. It's Monday, October 20th, and wow, markets are kicking off the week with a surprising bit of optimism. We're seeing green across the board in equities, S&P 500 futures are up, Europe is looking really solid, and Japan's Nikkei had an absolutely massive 3% jump. And at the same time, we're seeing US 10-year bond yields tick down just a little. So what does that all mean? Well, it tells us investors are in what we call a risk-on mood, feeling good enough to move into assets like stocks.
And this good vibe we're seeing in stocks, well, it's spilling right over into the currency markets. The US dollar is actually softening up a bit, while the Japanese yen and the euro are showing some real strength. You know, this is a pretty classic sign. When investors are feeling optimistic about what's happening in Japan and Europe, they start buying into those currencies too. And that's exactly what's driving the moves we're seeing right now.
So what's the overall feeling out there? Well, if we look at sentiment, it's pretty much right down the middle. We're not seeing extreme fear, but there's no irrational greed either. It's kind of like the calm before the storm, because lurking just beneath this quiet surface are some pretty serious global risks that could shake things up at any moment. Let's dig into the first one.
Okay, so the first big risk that's bubbling up is a real shocker that came out of Europe over the weekend. The rating agency S&P just went ahead and downgraded France's sovereign credit rating. Honestly, this was not on anyone's bingo card for the week, and it's sending a very clear signal of concern about the country's finances.
The new rating is A+. And yeah, this is a big deal. Why? Because it officially knocks France out of that elite AA club of borrowers. It's a symbolic hit, for sure, but it's also a serious warning sign that the experts are getting a little nervous about France's ability to handle its debt load.
This immediately puts a huge spotlight on Moody's. They're the last major agency that's still giving France that AA rating. And guess what? Their review is scheduled for this Friday. If they decide to follow S&P, it could actually trigger a wave of forced selling. See, a lot of massive investment funds have these super strict rules that say they can only hold top-tier AA-rated bonds. A downgrade would force their hand, making them sell, and that could cause some serious turbulence in the market.
Now let's shift gears from European debt to global geopolitics, because that economic tug-of-war between the US and China is really heating up again. The US has a pretty clear list of demands. They want China to buy more American soybeans, crack down on fentanyl, and give them access to their rare earth minerals. But China's got its own set of problems, and frankly its own points of leverage. They're dealing with weak demand at home, but they also hold a massive trump card, their near monopoly on those exact same rare earths the US desperately needs.
And this is where that whole rare earths thing gets really interesting. The US president is meeting with Australia's leader today to talk about one main thing: how to build a new supply chain for these critical materials that, you guessed it, doesn't rely on China. It's a very clear strategic move to try and break China's leverage and secure the resources needed for literally everything from our smartphones to advanced military tech.
Meanwhile, over in Europe, the conflict in Ukraine seems to be reaching an incredibly critical point. We're seeing reports surface from a very tense meeting between former President Trump and Ukraine's President Zelensky, with a truly stark message allegedly being delivered: accept Putin's terms or be destroyed. This really just highlights the immense pressure Ukraine is under to find some kind of resolution.
And it seems like that pressure is having an effect. President Zelensky is now publicly talking about the idea of a ceasefire right along the current battle lines just to get peace talks started. And in a really fascinating twist, the head of the European Central Bank is suggesting they could use Russia's own frozen assets to help fund Ukraine. With the whole situation being so volatile, it kind of makes sense that investors are flocking back to European defense stocks, which are soaring this morning after taking a beating last week.
And all of this geopolitical drama is unfolding while central banks are trying to walk this incredibly tricky economic tightrope. Here in the US, the Federal Reserve is sending a really clear message of caution. This quote from a top Fed official, well, it basically says, hey, we've already cut interest rates, and if we cut them anymore, we risk letting the economy run way too hot and bringing inflation roaring back.
So right now, the Fed's policy is what they call modestly restrictive. The best way to think about it is like gently tapping the brakes on a car. The whole idea is to slow the economy down just enough to get inflation under control without slamming on the brakes so hard that you cause a recession.
And the huge question everyone in the market is asking is it time to start taking our foot off that brake?
At the end of the day, it all comes down to inflation. And the one thing everyone is watching is the cost of housing. If rent and home prices keep cooling off, that could pull the overall inflation number down to a much more comfortable level for the Fed. So why does this matter so much? Because if inflation is finally under control, government bonds can become a genuinely safe investment again. When inflation's high, it just eats away at the returns from bonds. Taming it would restore their status as the classic safe haven for investors.
So how are all these big macro themes actually affecting individual companies? Well, let's start with a massive deal that's happening in the luxury world. Kering, the powerhouse that owns Gucci, is selling off its entire beauty division to L'Oreal.
And wow, did the market love this move. The reaction was immediate and it was crystal clear. This is a classic strategic play by Kering CEO. It's all about getting back to basics, focusing on what you do best and using the cash to pay down debt. Investors absolutely cheered the decision, sending the stock soaring 5.5% right at the opening bell.
And just like we touched on a minute ago, all this geopolitical uncertainty is having a very direct impact on specific sectors. The defense industry is just a perfect example. After falling last week on what seemed like hopes for peace, these stocks are now roaring back as investors look for safety in a really volatile world. It's a pretty clear barometer of market anxiety.
And you know who's leading the charge in Europe's rally this morning? It's the banks. Just last week, investors were getting pretty spooked by fears of a credit event, which is basically just the risk of a major default or some other kind of financial crisis. But for now at least, those fears have calmed down, and investors are piling back into the big European banking stocks, probably seeing them as a bargain.
So what's coming up? Well, looking at the calendar from investing.com, today might feel calm, but the rest of the week is basically a minefield of market-moving events. We've got huge earnings reports coming from tech giants Netflix and Tesla. Then on Thursday, EU leaders are meeting to tackle those big issues we talked about, like the frozen Russian assets. But really, all eyes are going to be on Friday. That's when we get the US inflation report, probably the single most important piece of data that could either make or break this market rally.
Which, of course, all leads us to the one big question just hanging over the market this week. Is this rally for real? I mean, we've started the week with a ton of optimism, but with massive earnings reports and that critical inflation number just a few days away, we're about to find out if this rally has legs or if it's maybe just built on a foundation of sand. That's all for today. Thanks for watching. Don't forget to like and subscribe.